Hello, everyone. I'm Michielle Freeman, Realtor with Edina Realty.
And I'm Steve Mohabir, loan officer with Edina Realty Mortgage.
And you're watching Tea Time Tips. Or I should have said, we're back.
That's true.
Yeah, we've been on a little bit of a hiatus here, Steve, from the Tea Time Tips. Been a good 2 months, I think.
Yeah.
So, what are you seeing? Like, what's going on in the market?
Well, I think last time we talked, things were pretty unstable. It was kind of the beginning of the middle of COVID, I would say. I don't know a lot about that, but
phase one of COVID, we'll say.
Phase one, yeah.
We were all stunned.
True, and a lot of the things that have been going on in Minneapolis as well. So,
yeah.
Real estate, weirdly enough, from what I've seen, it's still been as busy as I've ever been in my 18-year career. So it's very interesting to see what's doing this and what's driving this. Rates have finally stabilized a fair bit. For a while there at the beginning of April and end of March, rates were bouncing all over the place and actually quite scary, like to the point of one day they were 3%, the next day they were 5%, and then they were back to 3%. So,
oh wow,
little bit uneasy, but the government kind of stepped in and stabilized everything. So it's been a very, very good run here in the last 2 months, in particular, rate-wise, where rates have not climbed to pretty much above 3.5 for that 30-year fixed loan with some down payment and good credit. So
okay, so you mentioned a couple things in there that well, first of all, I knew that the rates were, I didn't realize they were as volatile as, like a 2-point swing. Like that's huge, and especially when we're thinking about people and their buying power. And then you also mentioned that the government stepped in. So with those 2 points, what did the government do to step in, and how did that affect the consumer besides stabilizing rates? And how does that swing in affordability get impacted by that 2-point swing that you were seeing?
Yeah, so the government stepped in and started buying treasuries and mortgage-backed securities to keep their prices low, and what that does to rates is keeps those low. So with volatility and nobody buying those products, rates go up real quick. And when COVID hit, I think companies wanted to hoard their cash and do that. I think there was just no appetite from a lender perspective, with a little uncertainty from Freddie and Fannie, from a little uncertainty before the CARES Act happened, the forbearance stuff that's been going on. So from a consumer standpoint, it's been really, really good. To your second point of what volatility has done, we only had really 2 really bad days. Both were Fridays, and they both retracted by Monday. So, but a normal 1-point swing in interest rates. So let's say rates are 3% today. Percent on we'll call it a $300,000 loan is about almost 10% reduction in the price you pay monthly for the same value. Given loan size and things like that will vary a little bit, but it's a quick thought where a 270 house today at 3%, or sorry, a $300,000 house today at 3%. If rates went to 4, you buy the same house with the same payment for 270 tomorrow. So that's where it's really impactful. But with the good news of rates being so low, we have great affordability in our metro. I know prices have gone up, maybe you can attest more to that than me, but the affordability is still there because rates year over year are down maybe 3/4 of a point or so.
Wow. Yeah, so I thought it was interesting that second quarter in 2020 was actually my busiest, highest volume quarter out of the last three. So out of fourth quarter 2019, first quarter 2020, second quarter was my most productive, which I found interesting because people were already kind of sitting in COVID at that point, staying at home. I think they had a lot of time to assess their home and what needs were being met and which things they would like to change. And they were taking advantage of the lower interest rates at that time. Like they were very conscious of that. So I've probably had more conversations on that than I have in a long time. And I usually direct them back to you because I'm like, I stay in my lane with that. But I also got a lot of phone calls of, okay, well, where are the good deals now? And I'm like, prices are not dropping. I'm still seeing multiple offers. I closed a deal yesterday, a transaction yesterday, that they were one of 11 people on the table. In June, I think is when we wrote the offer. So when you think of that, and that price point was it was over 4. So, there's still a lot of energy in the market. I will also say a lot of the economists and trends were saying that we were going to have an extended spring market and we probably wouldn't get the summer slowdown that we normally get. And I will tell you, I'm usually pretty dead after the 4th of July week, and I've just been hopping the last 10 days. So I think that it's going to hold true that we are going to see a trend of this is going to last a while as far as people trying to get resituated probably before winter. That's what I'm thinking.
Yeah, I think it used to be kind of before school.
Right.
And now with that uncertainty, I think winter is the next logical choice. I completely agree with you on that.
Sure. Now, I just posted an article that I read a couple days ago talking about how they think that actually, especially renters with this eviction moratorium being lifted, that some people might be a little more unstable and having to find a new home, shall we say, and how that could or could not impact people that own like larger unit buildings. Are you guys having that conversation on the mortgage side with that at all?
We've talked about it in my own brain and with some realtors that heavily concentrate downtown. Mm-hmm. We've talked about high density populations, and we talk about it in our meetings too, Amy and Michelle, where is there going to be a fleet? Is there going to be a fleet from high density 200 unit condo to yard and suburbs, so there's a little bit of space and no elevator sharing and that type of stuff. So do I see that happening? I do, but we always see that happening, right? Okay. There's just a flock from city to suburbia, and that's why there is suburbia, in my opinion. Or the flock to the outer city, not the down populated city. So I do think there'll be some movement from that. From your perspective, have you seen the condo market slow down? I know I was on an exceptional property meeting yesterday. The higher end condo market seems to be slowing just a little bit. Yeah.
So it's interesting. I think it's the price point of the condo. I think that the price point of condos, the buildings that are kind of attracting that first time home buyer, that's still super, super active and seeing activity. Condo buildings, which, attract the sort of right sizers, you say, the empty nesters that are giving up the home in suburbia and finding their next place. they're being a little more cautious. They're taking a little more time to make that decision. They're being a little more conscious of going on showings and watching the stock market, things like that. I definitely have had those conversations as well. So, and a lot of them that would normally pay cash for their next, condo, sort of, we're gonna have it as our second home, because we live, the winter elsewhere. They're hanging on to their cash a little bit. So
I completely agree with you, where retirees, are qualifying for not huge mortgages by any means, but enough where they still have a bunch of cash.
Mm-hmm.
They're not, if they're selling a $500,000 house and buying a $300,000 condo, they're still taking, $100,000, $200,000 loan out.
Yeah.
Just because they want to keep that cash for uncertainty. They've been through the recession, a great recession. They've been through a lot of things housing wise, and maybe they just want to be liquid versus not. So
the other thing I've been seeing lately is I've had more people say, I want to add real estate to my portfolio. So they're looking at investment properties. I've had two people, past clients, come out of the woodwork in the last 10 days saying that. So I think that, those people trying to bolster their real estate portfolios are trying to get themselves in position for if we do see the market sort of stabilize or stop seeing kind of skyrocketing housing prices, that they're ready to make that move.
Yeah, it's very interesting, and we'll see what happens. I tend to watch little gauges like what's the Chicago market doing. It's a little higher price point than ours.
Yeah.
And I also look at the other way. Look at the Des Moines market in our Midwest region. See what that's doing, and are there builders building? Right. That's another big piece. And are the builders building affordability? Right. Are they building $200,000 to $300,000 to $400,000 houses? Weirdly enough, that's affordable these days, I think, and with rates down anyway. Or are they concentrating on those higher end homes, 600, 700 plus?
Right.
So it's interesting to see as we go forward in 2020 and what happens.
Yep. Well, I'm so glad we're back.
Me too.
We're back. So summer hiatus is done. And congratulations on celebrating 18 years with Edina Realty Mortgage.
Thank you.
I feel honored that we get to partner every day.
Me too.
Yeah, so
it's been a good run so far.
Awesome. I agree. So everyone, you've been watching Tea Time Tips. I'm Michielle Freeman, Realtor with Edina Realty.
And I'm Steve Mohabir, Mortgage Officer with Edina Realty Mortgage.
And we'll see you next time.